Welcome to EduWap, your one-stop solution for e-learning. This video is about the concept of goods and service tax, also known as GST. Let's begin.
Goods and services tax is a comprehensive, multi-stage, destination-based tax that will be levied on every value addition.
Now, there are multiple steps an item goes through. Buying of raw materials is the first stage. The second stage is production or manufacture. Then, there is the warehousing of materials. Next, comes the sale of the product to the retailer. And in the final stage, the retailer sells you, the end consumer, the product, completing its life cycle. Goods and services tax will be levied on each of these stages, which makes it a multi-stage tax. Earlier, when a product was manufactured, the center would levy an excise duty on the manufacture, and then the state will add a VAT tax when the item is sold to the next stage in the cycle. Then there would be a VAT at the next point of sale. Goods and services tax will be levied on all transactions happening during the entire manufacturing chain, resulting in a multi-stage tax.
Let us understand GST with an example. A shirt manufacturer pays ₹100 to buy raw materials. If the rate of taxes is set at 10%, and there is no profit or loss involved, then he has to pay ₹10 as tax. So, the final cost of the shirt now becomes ₹100 plus 10 equals 110. At the next stage, the wholesaler buys the shirt from the manufacturer at ₹110 and adds labels to it. When he is adding labels, he is adding value. Therefore, his cost increases by say ₹40. On top of this, he has to pay a 10% tax, and the final cost therefore becomes ₹110 plus 40 equals 150 plus 10% tax equals ₹165. Now, the retailer pays ₹165 to buy the shirt from the wholesaler because the tax liability had passed on to him. He has to package the shirt, and when he does that, he is adding value again. This time, let's say his value add is ₹30. Now when he sells the shirt, he adds this value, plus the VAT he has to pay the government, to the final cost. So, the cost of the shirt becomes ₹214.5.
Explanation. The manufacturer purchases raw material. Purchase cost equals ₹100 plus 10% tax equals ₹10. Calculation, ₹100 plus ₹10. Final price equals ₹110. The wholesaler buys t-shirts from the manufacturer. Purchase cost equals ₹110 plus labeling cost equals ₹40 plus 10% tax equals ₹110 plus ₹40 equals 15. Calculation, ₹100 plus ₹40 plus ₹15. Final price equals ₹165. The retailer buys t-shirts from the wholesaler. Purchase cost equals ₹165 plus packing cost equals ₹30 plus 10% tax equals ₹165 plus ₹30 equals ₹19.5. Calculation, 165 plus 30 plus 19.5. Final cost equals ₹214.5. Therefore, Cost price equals rupees 100 plus rupees 40 plus rupees 30 equals rupees 170. Selling price equals rupees 110 plus rupees 55 plus rupees 49.5 equals rupees 214.5. Assumptions. 1. The rate of taxes is set at 10%. 2. There is no profit or loss involved. By the following practical example you can figure out the tax process.
Let us understand this with an example. A shirt manufacturer pays rupees 100 to buy raw materials. If the rate of taxes is set at 10%, and there is no profit or loss involved, then he has to pay rupees 10 as tax. So, the final cost of the shirt now becomes rupees 100 plus 10 equals 110. The wholesaler buys from the manufacturer. He pays a 10% tax on his cost price because the liability has been passed on to him. Then he adds value of rupees 40 on his cost price of rupees 100, and this brings up his cost to rupees 140. Now he has to pay 10% of this price to the government as tax. But he has already paid one tax to the manufacturer. So, this time what he does is, instead of paying rupees 10% of 140 equals 14 to the government as tax, he subtracts the amount he has paid already. So, he deducts the rupees 10 he paid on his purchase from his new liability of rupees 14, and pays only rupees 4 to the government. So, the rupees 10 becomes his input credit. When he pays rupees 4 to the government, he can pass on its liability to the retailer. So, the retailer pays rupees 140 plus 14 equals 154 to him to buy the shirt. At the next stage, the retailer adds value of rupees 30 to his cost price and has to pay a 10% tax on it to the government. When he adds value, his price becomes rupees 170. Now, if he had to pay 10% tax on it, he would pass on the liability to the customer. But he already has input credit because he has paid rupees 14 to the wholesaler as the latter's tax. So, now he reduces rupees 14 from his tax liability of rupees 10% of 170 equals 17 and has to pay only rupees 3 to the government. And therefore, he can now sell the shirt for rupees 140 plus 30 plus 17, 187 to the customer.
Explanation. Manufacturer buys raw material. Purchase cost equals rupees 100 plus 10% tax equals rupees 10. Calculation, rupees 100 plus rupees 10. Final price equals rupees 110. Wholesaler buys the t-shirts from the manufacturer. Purchase cost equals rupees 110 minus tax paid by manufacturer equals rupees 10. Now, purchase cost equals rupees 100 plus labeling cost equals rupees 40 plus 10% tax equals rupees 100 plus rupees 40 equals rupees 14. Calculation, rupees 100 plus rupees 40 plus rupees 14. Final price equals rupees 154. Retailer buys the t-shirts from the wholesaler. Purchase cost equals rupees 154 minus tax paid by wholesaler equals rupees 14. Now, purchase cost equals rupees 140 plus packing cost equals rupees 30 plus 10% tax equals rupees 140 plus rupees 30 equals rupees 17. Calculation: rupees 140 plus rupees 30 plus rupees 17. Final cost equals rupees 187. Claiming the input tax credit in GST. The manufacturer pays 10% tax to the government equals rupees 10. After purchasing t-shirts from the manufacturer, the wholesaler pays 10% tax to the government equals rupees 14. But the wholesaler actually pays rupees 4 as tax, since the manufacturer had already paid rupees 10 tax before. Same way. After purchasing t-shirts from the wholesaler, the retailer pays 10% tax to the government equals rupees 17. But the retailer actually pays rupees 3 as tax, since the manufacturer had already paid rupees 10 as tax and the wholesaler had paid rupees 4 as tax respectively. Therefore, the total tax paid to the government is rupees 17.
Conclusion. Cost price equals rupees 100 plus rupees 40 plus 30 rupees equals rupees 170. Selling price equals rupees 110 plus rupees 44 plus rupees 33 equals rupees 187. Assumptions. 1. The rate of taxes is set at 10%. 2. There is no profit or loss involved. With the following practical example you can understand the whole GST concept.
Benefits of GST. 1. Reducing the tax burden on the final customer. 2. Reduce the cascading effect of taxes. 3. Allowing input tax credit. 4. Reduce the burden of taxes. 5. A small reduction in the prices of goods and services. 6. India will be on par with foreign nations. 7. It is a more structured tax system. 8. A single tax on goods and services. 9. Goods and services tax will improve the collection of taxes. 10. Boost the development of Indian economy. 11. It will remove the indirect tax barriers between states. 12. Integrating the country through a uniform tax rate. One nation, one tax.
Thank you for watching. Share this video and spread the knowledge. You can also tweet me at Nawani10. Click here to subscribe. Don't forget to press the bell icon on the YouTube app and miss another update from EduWatch.